Hi, welcome to week 7 of financial management. This week, I'll be talking solely on just on one chapter. Last week was a tough one, looking at two chapters. Last week, we looked at the concept of discounted cash flow, this whole present value, future value, and valuation, where those concepts actually get applied. So if we're going to do present value, we're going to use the idea of present value and cash flow to apply that to valuing financial instruments, specifically stocks, are called equity, and also bonds. So if you remember, with stocks, this will all be applied this week as well. With stocks, you get cash flows potentially from two ways. You get dividends, so if companies pay dividends, a lot of them do. And secondly, in something called capital appreciation. And that means this is probably the norm for a lot of younger investors like yourselves. You pay one price, hopefully down here, and then you sell it up here. That's called capital appreciation. Ideally, that's what's happening. You're buying it down here and selling it up here. But if you buy Tesla, my own editorial, you might get burned. You might buy it up here, and then you might sell it down here. And that's also called capital appreciation. So again, equities, you value the cash flows of dividends. That would be one. You'd come up with a number for that of the present value of future dividends. And then secondly, you say, okay, I think I might sell the stock for X, Y, or Z in the future. How much would that be worth now? So that's equities. Bonds act differently because you get a fixed coupon payment that stays the same. You would take the principal, like $10,000 or $20,000, a multiple of thousands. You multiply it by the interest rate, or called the coupon, and then that tells you what your coupon dollar amount's going to be, and that's finite. And finite means that annuity payment's going to last to a certain time. So your cash flow payment is going to be viewed as what's called an annuity. So you'd want to calculate what's the present value of that annuity. That's one part of valuing a bond. The second part of valuing a bond is that at a certain time the bond matures, it ends. It has a finite life. It could be in 5 years or 10 years or 15 years. But at the end, you're going to get what's called the principal, the face value of the bond. Again, it could be 20,000 or 50,000 or $1 million. That's what you're going to get at the end if you own the bond. So in calculating the value of a bond, we say, okay, I'm going to get $1 million in 10 years. And I know that that's not going to be, it's not worth $1 million now. So what's the present value of $1 million in 10 years? I come up with that amount. I add that to the annuity, meaning all those all the interest that I'm going to receive between now and then, and I combine them, and that tells me whether my bond is trading at a par, premium, or discount. Okay, meaning above $1 million, below $1 million, or exactly at $1 million. Rarely is it exactly. So that was last week, but now this week we're going to come up with the percentage that we use to discount those, called the cost of capital. So firms always have to decide when they're going to, it's very normal for companies to be raising capital. And capital could be equity, or it could be bonds. The book talks about equity being preferred stock and common stock. I will spend more of my time on the common stock, the equity stock, and or in bonds. Okay, so they both act differently. You've been hearing me talk more and more about those two instruments. So what we're doing here is we're thinking about from the company perspective. If the company has a project, or they're going to do a merger, or they're going to expand, or they need capital because of the COVID, right? They need more capital for some reason. We're not even deciding whether it's a good reason or not. So you're the company, you're saying, okay, I need to raise capital. Which one, first of all, how should I raise the capital? Should I sell more shares, right? Should I float more shares out into the market? And that's called equity, right? That means people will say, oh, yeah, I understand that that Google already has shares out. They're selling more shares. So I kind of know how their shares have behaved. There's a track record. I'll buy some more shares. That's one way. A second thing is to borrow money. So first of all, we're making assumptions in this course that our companies, that in the companies for your final project, are all mature companies. They have an opportunity to either sell shares or borrow money. A lot of firms at the very beginning, like in your capstone, when you're doing this same process, a lot of companies without any track record are never going to be able to borrow money because there's no collateral. It might be an idea or something. It's going to be equity. Equity is riskier for investors, so the company is going to actually have to pay more money to raise equity. So again, this week you're looking at how to calculate the company's it's called weighted average cost of capital. So you need to look at first of all, in the book they're going to give you scenarios, but you're looking at a company's finances, its balance sheet, and you're saying, okay, how much equity capital do they have and how much debt capital do they have? And you're going to sum them up. That's their total capital. You're going to get a percentage, a pro rata percentage. So that's going to be the weight of WACC. Okay, average is going to say, okay, now I got to figure out if the company right now has stock out there, how much does it cost? What's the rate to raise more stock, to raise more equity? There's going to be a cost. It's generally going to be significantly higher than the bonds, by the way. So if I'm going to sell stock, which again is riskier, investors know that, I'm going to have to pay more if I want to raise more money. So my current equity cost, let's say, is 13%. And then I'm going to come up with that and say, okay, it's 13%. And you'll see how two different ways to calculate the equity part. So there's my equity. My current cost is 13%. If I go to raise money, it'll cost me 13% of equity. Now, if I borrow money, it's different. Borrowing money is generally less risky, so it'll be less than 13%. And you have the benefit of taxes because the government, as a policy, wants firms to borrow, specifically if they're going to plow back into their business. So on an income statement, you'll see that interest gets deducted before taxes, right? So that means that when a company borrows money, they're effectively they're not paying the full amount because they're getting a deduction. If you own a home, by the way, this falls to individuals. If you own a home, the government also allows you to deduct your interest for home interest as well. It's all deductible. So again, as a policy, the United States wants you to borrow. So you come up with what the current yield is. That's yield means interest over the price for bonds, and then that becomes your yield becomes your starting point, and then you figure out what the tax rate is. You get the after-tax rate, and then that is the equivalent bond yield. So I have my equity yield, we said was 12. Maybe my bond yield is 3%. And then we weight them times the weight of each one, right? So, and you'll see in the book how that works. Now, for your firms, your specific firms, this week you want to be thinking about, and you need to calculate ultimately what your firm's weighted average cost of capital is. So you need to look at your company's financials from 2019, see what the equity is, see what the debt is, and then come up with Excel. And on the module, the Excel valuation that I give you, it's all in there. You can plug and play, and then it'll walk you through. You can get the weight easily, but then you have to fit. There's a couple different methodologies of equity. There's two methodologies for equity to come up with what the cost of capital is. So, one of the reasons why we want to know the company wants to know is in why this whole thing we're doing this whole thing is this ties directly to a company's financial structure. So once you come up with this number, it allows a firm to make decisions about every single thing because it's reflecting the weight or it's reflecting the underlying financial structure, whether it's all equity, all debt, or a mix. Second, reflects the market perception of the company. So if it's a public company, right at hand, this weighted average cost of capital reflects what the markets, what the individual people think about the company. That's reflected in this weighted average cost of capital. It also incorporates alternatives for investors. So one of the methodologies for the equity side is called the CAP-M model, and it's in Chapter 11. It makes an assumption that, by the way, this was a Nobel Prize winning idea. It reflects an assumption about risk and a floor that an average investor has different choices to invest, and a floor would be a government bond, a government risk-free return, right? So that gets reflected in this CAP-M. So that's very helpful. And then again, I think I emphasized this at the beginning, this weighted average cost of capital is very, very helpful for management to as a guideline, right? To guide them. So again, before, up until now, in the last couple of weeks, when we'll be doing present value, it just kind of gave you an interest rate. It didn't really talk about where that rate came from. So now we're going to apply this weighted average cost of capital to specific companies. Every company probably has their own. I don't think any two companies technically would have the exact same weighted average cost of capital. Probably none are exact. It could be close, but just mathematically it would be pretty random because companies are all over the place with size and choices and taxability. So again, what you're going to do is for your specific company is you're going to come up with your own weighted average cost of capital for your company. Happy to help you do that. And then that's the rate, the percentage you use is how you're going to discount your cash flows. That's going to be the percentage that you use for your 5 years. The 5 years that are going out, you're going to say, okay, here's my company. The next 5 years, I think the free cash flow will be this. All right, now I got to discount them. What percentage do I use? You're going to use the company's weighted average cost of capital. So a lot of stuff to do. Again, glad it's just chapter 10. On Wednesday night, I will definitely be going over this specifically. We'll look at an example. We'll look at Federal Express together. And lastly, I will be giving you your your specific companies. I'm going to be giving you your bond yields because you need that number and it's hard to get. So good luck. Nice work, everybody. You've been doing a great job in the class.